Hi everyone, Nick here. Welcome back to my channel. In this video, we'll take a strategic look at international stock funds. We're going to look at an overview of the global equity market and different funds that offer an efficient way to invest in international stocks. Then we'll look at some important factors for constructing your international stock portfolio. We'll start with a high-level breakdown of the global stock market. Here's a tree showing the breakdown. At the root or top of the tree, we have the global stock market. Now let's step down the tree one level. At this level, we break it down by US versus ex-US. This is because the US stock market represents approximately 57% of the global equity market. The ex-US portion represents the remaining 43%. At this point, we can step down another level in the ex-US branch, and we divide it between developed and emerging markets. Developed markets account for roughly 75% of the ex-US market, while emerging markets account for the other 25%. Developed markets are basically most countries in Europe, then Japan, Korea, Australia, Hong Kong, and a couple more. Emerging markets include countries like China, Taiwan, India, Brazil, Mexico, Russia, and many others. Should we invest in all of these countries? This is a question that many experienced investors spend hours debating. Markets have historically gone in cycles, where the US has outperformed for, say, 10 years, as it has recently. Then, international markets outperformed for several years, and the cycle has repeated. Who knows what the future holds? If you're watching this video, you probably want to diversify your portfolio globally and mitigate the political, economic, currency, and other risks of one country. If you're still on the fence, I made a video covering this, which I'll link up here and below. I even interviewed two investors that argued each side of this debate. How do we efficiently invest in the global market? The most efficient thing you can do right now is to smash the like button to support free financial education. Subscribing is another great way to show your support. I put a lot of valuable information into this video for you. This is all I ask for in return. Thank you for your support. Vanguard has created amazing index funds that make it simple to efficiently invest in the global stock market. Vanguard has index funds for each level in this tree. At the root or top of the tree is the total world stock market index, which matches the market cap weighted performance of nearly every publicly traded company in the world. For many investors, this single fund could be their entire stock portfolio. The ticker for the Total World Index is VTWAX for the mutual fund and VT for the ETF. These are the same fund, just two different share classes. The fund tracks the FTSE Global All Cap Index with 9,074 companies in over 40 countries. I made another video detailing this fund, which I'll link up here and below. At the next level, Vanguard has VTSAX or VTI for the total US stock market index. But we're focusing on international in this video. For international stocks, they have the Vanguard Total International Stock Market Index, ticker VTIAX for the fund and VXUS for the ETF. This fund tracks the FTSE Global All Cap ex-US Index. It allocates your investment across 7,526 companies in over 40 countries. Next, we step down another level. We have the Vanguard Developed Markets Index, ticker VTMGX for the fund and VEA for the ETF. This fund tracks the FTSE Developed All Cap ex-US Index. It allocates your investment across 4,029 companies in over 20 countries. The Emerging Markets Index is ticker VEMAX for the fund and VWO for the ETF. This fund tracks the FTSE Emerging Markets All Cap China A Inclusion Index. It allocates your investment across 5,225 companies in over 20 countries. There are other companies than Vanguard that offer good alternatives, and I'll discuss a few of them at the end. Before that, let's discuss why you might choose to invest in one level of this tree versus another. There are several reasons. Let's discuss a few of them. First is the tax treatment of the funds. In taxable accounts in the US, we can take a tax credit for taxes paid to foreign governments by a fund, but only if the fund has over 50% of its holdings in international companies. The Total World Index currently only holds 43% of international stocks, so it doesn't qualify for the tax credit. The fund is paying the taxes regardless, and for many people it makes sense to hold the international stock fund separately in a taxable account so they can get the tax credit. International stocks do tend to pay higher dividends, which could mean more dividend tax or the 3.8% net investment income tax for high income earners. You can weigh the pros and cons for your scenario, but this is the first reason to hold US and international separately. Second are the fees. It's a little cheaper to hold the fund separately. Here is a table showing the breakdown of investing in the US and international separately instead of VTWAX. If you match the weightings of VTWAX, your fee would be almost 0.03% lower. This is about $2.99 for every $10,000 you have invested. For $1 million, this would be $299 per year in fees that you would save. For the ETF versions of these funds, the yearly savings is almost identical at $2.85 for every 10,000 or $285 for every million. You can save even more if you invest in developed and emerging market indexes separately. If you match the weightings of the total international fund, you would save a bit over 0.02% in fees, equating to $2.25 for every $10,000 or $225 for every million. For the ETF versions of these funds, it's a little less at $1.75 for every 10,000 and $175 for every million. If you're going to retire with a $2 million portfolio, this could be worth an extra $1,000 in your pocket each year. That's a good amount of money. You would be stuck with rebalancing your portfolio yearly to match the global market. It may also be a little more difficult to rebalance if you're using a taxable account, but could possibly be done in conjunction with a tax-advantaged account to avoid realizing capital gains in the taxable account. Speaking of rebalancing, the third reason is simplicity. The global stock market distribution changes all the time. Next month, it might be 55% US and 45% international, or 70% developed and 30% emerging markets. You can just buy the Total World Index and be done with it. It's a great fund for simplicity and minimalism. If you do end up holding separately, every quarter the FTSE Global All Cap Index fact sheet is updated to show the latest weightings. You can just match these weightings. Developed and emerging is a little more involved to calculate. I usually just go to the Bogleheads wiki for this information, which I'll link down below. You could also use the FTSE Global All Cap ex-US fact sheet to determine this yourself by totaling the percent allocated to countries that are considered developed markets or emerging markets. A fourth reason to hold some of these funds separately is some investors don't want to match the global market weightings. They may want to invest more or less in international stocks. They may also want to entirely avoid some emerging markets or to overweight emerging markets. Each investor has their own reasons and can customize their portfolio as they desire using a combination of these funds. I personally believe in going after the average return of the global market. By doing this, I'm relying on the millions of investors around the world to figure out the best allocation of capital. The fifth reason is you may have no choice. In many retirement plans, like 401ks or HSAs, you only get to choose from 20 to 30 funds. In order to provide their participants with the most flexibility, these will typically only have the more granular options. My 401k plan has institutional versions of the developed and emerging market indexes. Even though I try to hold all of my international exposure in a taxable account for the tax credit, my taxable account isn't large enough to hold them all. While I go for simplicity with VTIAX in my taxable account, in my 401k, I have to hold developed and emerging separately at the 75 to 25% ratio to approximate the total international index. Those who watch my channel know I believe in the 3-fund portfolio, which is simply holding a total US market index, total international market index, and a total US bond index. This is one of the most efficient portfolio when it comes to your time, taxes, fees, and getting one of the best risk-adjusted returns. I made another video detailing why I believe it's the best fund for most investors. And I'll link that video up here and below. Even if you hold developed and emerging markets separately, they're the same as the total international, the 75 to 25 ratio. The investment philosophy is the same as the 3-fund portfolio. Other companies like Fidelity, Schwab, and iShares also have equivalents of some of these funds. For instance, I used to invest in Fidelity's Total International Market Index Fund, ticker FTIHX, which is a good alternative to VTIAX. In general, I think Vanguard has the best index funds. I also like that Vanguard is the company that drove delivering such great products to investors and is a nonprofit owned by those that invest in its funds. The Bogleheads Wiki has some great information on approximating the total international market with other alternatives. Here are a couple examples. State Street Global Advisors has developed an emerging market ETFs. The Developed Markets ETF is ticker SPDW, and the Emerging Markets ETF is ticker SPEM. These track the S&P versions of these indexes instead of the FTSE version. The ratio with this one is currently the same as Vanguard at 75% developed and 25% emerging. iShares also has developed and emerging markets ETFs. The Developed Markets ETF is ticker IDEV, and the Emerging Markets ETF is IEMG. These track the MSCI versions of these indexes. The ratio here is a little different, with 70% developed and 30% emerging. You can see the Bogleheads Wiki is using the Morningstar style box to show the fund's high-level exposure to companies with different market caps and value. If you want to learn more about the style box, watch one of my videos comparing a couple indexes, like the S&P 500 versus NASDAQ 100 video, or S&P 500 versus Total Stock Market Index video. If you really like one index provider more than another, you could choose Vanguard for FTSE, State Street for the S&P, or iShares for the MSCI. In reality, they're probably close enough to be negligible. They all have roughly equivalent fees. Thanks for watching, everyone. Please comment below and share your strategy for investing in international stocks. If you got value from this video, make sure to smash the like button and subscribe. Later.